Hello friends, let us continue with redemption of debentures. Right? And in redemption of debentures, in the last lecture, we did one very important topic, that is DRR, creation of debenture redemption reserve. Right? What we discussed in DRR? Let us quickly see. We say at the time of issue of debentures, amount to be paid at the time of redemption is decided. That we all know. And two things I told you, that payment to debenture holders is an obligation for the company. That means whether you are earning profits or not, you have to pay money to the debenture holders. Right? Second thing, debenture holders are always paid before anything is paid to the shareholders out of profits. That is, out of profits, before the dividends are given to the shareholders, you have to give money to debenture holders. Clear? Then we say Companies Act 2013 says that after issue of debentures and before redemption of debentures, companies need to transfer a part of profits to a separate reserve created for redemption of debentures known as DRR, Debenture Redemption Reserve. Right? And this transfer is to be made before giving dividends to shareholders. Clear? Then we say, what is the amount that is to be transferred to DRR? Amount to be transferred is minimum 25% of the total face value of debentures that is to be transferred to DRR. What is important here is minimum 25%, and 25% of what value? 25% of face value of debentures, and not the discounted or premium value. Whatever is the face value, on that you have to calculate 25%. Minimum 25%. You can transfer more than 25% or you can transfer less than 25%. Sorry, not less than 25%. Minimum 25% you can transfer more than 25%. Right? Then what is the journal entry for transfer of DRR? The journal entry is surplus account debit to debenture redemption reserve account. Clear? After the redemption of debentures, if any amount is left in DRR, that will be transferred to general reserve. Clear? Then I told you that DRR is created on non-convertible debentures. Right? And there are four type of companies which are exempted from creating DRR. All India financial institutions regulated by RBI, other financial institutions regulated by RBI, banking companies and National Housing Bank. So these four type of companies, they are exempted from creating DRR. For all the companies it is mandatory to create DRR equal to minimum 25% of the face value of debentures to be redeemed. Clear? Now, this is about DRR. Now, why we are creating DRR? We created DRR to secure payment to debenture holders, isn't it? To secure the payment to debenture holders, we created DRR. The second purpose was to avoid making payments from capital, to avoid making payment from capital. Right? It is never a good sign for the company if the company has to make such payment of liabilities from its capital. Right? Remember that example of piggy bank that we did in the last lecture. There I told you that it is never the intention to break the piggy bank. Right? You never want to break your piggy bank. Clear? So to avoid making payments from the capital, we create DRR. Now what we are going to do in this lecture is another important topic. Something similar to DRR, we call it as debenture redemption investment. Right? Now, what is this debenture redemption investment? There is again a provision given by Companies Act 2013, like regarding the DRR, they have given a provision regarding debenture redemption investment. What they say is, in addition to DRR, invest some money out of profits in specified securities. Right? Companies Act says, again, to secure the payment of redemption, the payment on redemption of debentures, they say in addition to DRR, that is after creating DRR, invest some money out of profits in the specified securities. Now, what are the specified securities? The securities which have been specified for the purpose of redemption by Companies Act 2013. Clear? Specified securities are those securities which have been specified specially for the purpose of redemption of debentures. And who has specified this? This has been specified by Companies Act 2013. Clear? So Companies Act says that in addition to DRR, you have to invest some money out of profits in specified securities. Right? This is done to secure payment to debenture holders. Right? And also to avoid making payment from capital. Clear? So the purpose of DRR and the purpose of DRI, this debenture redemption investment, we call it as DRI. The main motive of creating these two things is almost similar. There what we do is we are taking some money out of profits and keeping it in a separate pocket. Right? We call it as debenture redemption reserve. Here what we are doing is we are taking some money out of profits and we are investing in the specified securities, and from that investment we might earn some return also. Right? In the DRR case, we are not investing money. We are just taking the money from one pocket and keeping it in second pocket. In case of DRI, what we are doing is we are taking money out of one pocket and investing in some specified securities that have been specified by Companies Act. Right? So this is done to secure payment to debenture holders and also to avoid making payment from capitals. Right? Now, what is the amount that is to be invested? Amount to be invested. Now, what is the amount in case of DRR? That is minimum 25% of face value. In case of DRR, it is minimum 15% of the face value of debentures to be redeemed. Right? So, in DRR, the amount is minimum 25% of the face value, and in case of DRI, this is minimum 15% of the face value. This word is important, face value. Right? Always remember this. There it is minimum 25% of face value, and in case of DRI, this is minimum 15% of the face value of debentures to be redeemed. Clear? This is the amount to be invested in the specified securities. Clear? Then the question is when to make investment. Right? Now Companies Act specifies when you have to make this investment. Let us see. Suppose on 1/4/2016 you have issued debentures of 1 lakh rupees, right, which are redeemable after 2 years. This is 31/17. This is 31st March 2018. Now here they are redeemable for rupees 1 lakh. Clear? So on 1st of March 2016 you have issued debentures that are redeemable after 2 years. Now the first thing is you have to create DRR. In this period you have to create DRR. DRR is equal to minimum 25% of face value. This is clear. Now we have to create DRI also. Now when we have to create DRI, DRR can be created throughout this period of 2 years. Anytime when you have profits, create DRR 25% of face value out of profits. Now when to create DRI, this is quite important. When we have to create DRI, they say these debentures are redeemable on 31st of March 18, right? So you have to create DRI before 30th of April 2017. So the debentures which are redeemable on the 31st of the next year, that is 31st March 18, you have to create DRI that is equal to minimum 15% of face value, and this is to be created before 30th of April of the year, right? So if your debentures are redeemable next year 31st March, that is 31st March 18, you have to create DRI on or before 30th of April 2017. And if you have some debentures redeemable on 31st of March, then you will create DRI on or before 30th of April 2016. Simple. Clear? So this is about debenture redemption investment. What is the amount to be invested? Minimum 15% of the face value of debentures to be redeemed. When this investment is to be made? This is to be made for the debentures which are redeemable on 31st of next year. It is to be created on 30th of April, on or before 30th April. Let us see the provisions regarding this. Debenture redemption investment. Company is required to make investment in specified securities. What are specified securities? The securities which have been specified for the purpose of redemption of debentures. These are specified by Companies Act 2013, right? So you have to make investment in those particular securities only which have been specified for the purpose of redemption, right? Then amount of investment is equal to minimum 15% of the face value of debentures that are to be redeemed. Clear? So you have to invest minimum 15% of the face value. Now when this investment is to be made, this is to be done for those debentures which are to be redeemed by 31st March of next year, say 2017. Provision is to be created on or before 30th April of this year, that is 2016. So the debentures which are redeemable on 31st March 17, for those debentures provision is to be created on or before 30th of April this year, that is 30th April 2016. This means we have to invest in the specified securities on or before 30th April 2016. Clear? And the last point says this is to be done by only those companies which are required to create DRR. Here, see, there are 4 types of companies which are exempted from creating DRR. The last line says this is to be done by only those companies which are required to create DRR. That means these 4 companies, All India Financial Institutions, other financial institutions, banking companies and National Housing Bank, they are exempted from creating DRI also. So DRI is to be created by only those companies which are required to create DRR. Clear? Clear, friends? Right? So this is about debenture redemption investment. Now, one important point regarding this debenture redemption investment. What to do of this investment at the time of redemption? Right? Suppose on 1/4/2016 you issued 1 lakh debentures, right, which are redeemable after 2 years, 31st of March 17 and 31st of March 18. So these are redeemable here. Clear? You created DRI on or before 30th of April 17. That is minimum 15% of face value. Clear? Now, at the time of redemption, that is here 31st of March 2018, what to do with these investments? There are 2 methods. One is encash these investments. Encash these investment means sell the investments and get the cash. Right? The first method is get the investments encashed just before the redemption of debentures, and whatever money you get from the encashment, that money can be used for redemption if required. Encash these investments, then use money for redemption if required. Right? Now this is done just before redemption. Clear? So the first thing is you can encash these investments, and further you can use this money for redemption if required. Clear? Now, what is the other alternative? You can keep these investments for further redemptions. The second thing you can do is, if you have to redeem some other shares after 31st of March 2018, say on 31st of March, say on 31st of March 19, you have to redeem 50,000 debentures, right? So for these you will have to create on or before 30th April 18, you have to create investments to the extent of 15% of face value of debentures, right? So they say instead of encashing these debentures on 31st of March 18, what you do is, if you are able to pay this 1 lakh rupees, you don't need these investments, right? What you do, you keep these investments for the further redemption of debentures. You keep the money invested to the extent of 15% of the face value. Rest of the investments you can in cash, and whatever investments are required here, you keep the money invested that will be used for redemption on 31st of March 2019. Clear? So basically there are two alternatives. One is encashment, other is keep these investments for further redemption. In most of the cases, you will encash the investments just before the redemption, right? So we'll discuss more about this when we'll do the practical problems. You will get more clarity how we issue how we are investing in the specified securities, and then how we are encashing these investments, right? What is going to be the journal entry for investment? It will be investment account debit to bank account, right? Then at the time of encashment, bank account debit to investment account. Clear? So these are your journal entries for investment in specified securities, that is debenture redemption investment. Clear, friends? So the concept of DRR and DRI, is this clear to you? The main purpose of both these things, both DRR and DRI, is to secure the payment to debenture holders plus to avoid payment from capital. It is never a good thing if you have to move your capital for the payment of these liabilities. It is always good to pay these liabilities out of your profits or your reserves. Why I am saying reserves? Because reserves is nothing but a part of profits only. That means your business is doing very good, that you are able to meet your liabilities from your profits. Clear? So the main purpose of these two things is clear. Remember the amounts to be transferred. In case of DRR, it is minimum of 25% of face value. Remember this face value, it is very important. Clear? Then in case of DRI, it is minimum 15% of the face value of debentures to be redeemed. Right? And when this investment is to be made? For the debentures which are to be redeemed on the 31st March of next year, the investment is to be made on or before 30th of April this year. So that means if the debentures are to be redeemed on 31st of March 18, you have to make investment on or before 30th of April 17. Right? So friends, this is about DRI and DRR. Right? If you have any queries, just send me an email at ksjteaching@gmail.com. Right? So in the next class, we are going to discuss about the methods of redemption. Methods of redemption of debentures. Right? So friends, feel free to give your queries at this email. I will definitely respond you back. Right? So that's all for this lecture, friends. Thank you so much.